What's up guys, my name is Kurt, and in today's video we are going over a very important topic if you are going to be investing in real estate, and that is how you run the numbers. Obviously we go into this because we want to make money, we want financial independence, and you don't get that by just buying any real estate. You buy it by getting real estate that cash flows, because if you buy the wrong deal and it costs you money, you're writing a check each month, it's not going to be so great of an experience, and it's definitely going to stunt your growth and your path towards financial independence and building a nice real estate portfolio. So this is actually a topic that was requested by somebody in the comments of a previous video that I did. So you ask, I try to deliver, and let's get into it. So here we are. This is the spreadsheet that I personally use to analyze my deals. This right here that you see is just a copy of the standard template that I put on my website in order for you guys to download. That website is www.kurtbagney.com. If you go on there, you have the option to download this exact spreadsheet. Don't put too much stock into the numbers that I have in this sheet right now. They're just kind of placeholders. Obviously, it's for you to take and tweak and enter your own numbers to analyze your own deals. But in this video, I will go over 4 different deals that I've personally done. You can see my numbers on them, how I analyze them, and the returns that I'm getting from them. And they're kind of different types of deals. So if you watch one and think, oh, I know everything, no, stick around. They're actually like different types of deals that you can do in real estate. Some that are more cash flow oriented, some that are more geared towards forced equity, some where you get infinite returns, some where you leave some money in the deal, but you're getting a good return on that money, so you're happy. Some you get everything. You get the cash flow, you get the infinite returns and all that. So we'll get into some different types of deals that I've done, and hopefully you can learn something from it. So this one here, it was a deal that I got in Pontiac, Michigan. This is an example of a straight cash flow deal. Although there is some equity that I gained from purchasing this just due to kind of market tailwinds, it's worth a decent bit more than what I paid for it, and I didn't really have to do a lot of work to get that. But we'll get right into it. This column on the left here is inputs. If it's shaded in blue here, it's an input. The cells that aren't shaded blue, they're not intended for you to enter numbers into. Those are outputs. So we'll start with purchase. These are the parameters that you're purchasing the property under. So over here we have the sales price. I spent $134,000 on this property, or that was the sales price, because I took advantage of leverage. I didn't actually personally have to come up with that much cash in order to do the deal. Rehab cost, that's what you would spend in order to fix up the property and get it rent ready. As I said, this property was already, it was a cash flow play, so I didn't have to do much to it. It was essentially turnkey. It's a triplex. 2 of the units were rented upon purchase. One of them was essentially rent ready, and I just had to clean it up a little bit and place a tenant, so that's what I did. The $3,000 that went to like a little bit of cleanup, tree trimming, fixing the gravel driveways so there weren't like muddy ruts in it, that type of thing. Just basics to, kind of keep the place up. Closing costs, there's going to be some costs when you close, and there'll be more if you finance the property because you'll be paying points towards your loan to buy down interest. There lender closing costs, and you might be paying prorated taxes and other this and that. So that's kind of where that gets baked in. Also, documentation recording fees and paperwork fees, title fees. There are a lot of fees when you look at a closing statement. So that's what this is about. ARV, that's an acronym that stands for After Repair Value. That's what it's worth once you buy it and fix it up. This one I didn't do a lot of fix up necessarily, but for ARV, I just plugged in the present day market value, which I believe is in the neighborhood of $175,000. Rents. So it's a triplex. Between the 3 units, 2 of them are rented for $850 a month, one's $775. Because it was kind of a turnkey property, I didn't have to do much to them, but also because I didn't do much to them, it's not all like pushed to the max in terms of being super nice. Like obviously they're decent habitable units, but it's not super high end, and that's reflected in the prices. Utilities per month. I don't bill back any utilities on this property. It's individually metered for gas and electric. Other income, I have a washer and dryer on the property. You could pay either with an app or a coin. We're figuring about $25 per month in income from that. It might actually be more like 50 or so. I haven't looked at my reporting on that in a bit. Income increases. Over time, rent tends to go up. That's not going to show up in your first year outputs here, but if you go to this return over time tab, you can see how income and so on tends to increase over time along with the expenses. Yeah. It's not something you'd count on when you're doing a real estate deal, but it can be gravy, and it can be a lot of gravy in some situations. So it's nice, but not something you want to rely upon. Expenses, oh, the fun part. Now I just have some assumptions in here. Maintenance, that's what you spend to fix things if things break. Like let's say your water heater breaks, you assume like 8% of gross income per year is going to cover instances like that. Things that fail, need to get fixed. That's what that's for. CapEx, again, that's an assumption of 6% gross to go towards improvements in the future, because if you don't improve your property over time, it's just going to degrade and it's going to get to the point where nobody wants to rent it anymore. You have to protect your investment by continuing to invest in it. Vacancy, typically you're not going to have 100% occupancy. Some properties you might over a nice span of time, and that's fantastic when you do, but you don't underwrite to 100% occupancy because in reality you have turnover. This assumes that 6% of my gross income or potential gross income is lost to vacancy. Management, I self-manage my properties, so that is not a fee that I am personally paying, so I put in 0. For multifamily properties, typically the bank will want to see the deal underwritten with management in place because most buyers of multifamily, at least like the larger commercial stuff, a lot of them will have professional management, and the deal needs to work with that in place. So a common number that commercial appraisers plug in seems to be about 5%. Banks are happy with that. So yeah, do with that as you will. Utilities, I pay the water bill on this property. My assumption is that I pay about $600 per unit per year. That tends to be pretty accurate across my portfolio, so that's why I say $1,800 here. Additional expenses. I actually should have something in here because I pay to have the lawn mowed. It's not that much, but let's say over the course of the year, it's like $600. So I'll fix that. Insurance, it's about $1,800 per year. Taxes about $2,000. Your expenses too will go up over time. Inflation's a little high right now, so I don't know, I'll put in 3%. Maybe it's more, maybe it's less, but ideally your deal's not going to be so thin that a couple percent of expense increase or whatever is going to destroy it. Now we get to our outputs. This is kind of where it gets fun. Your gross income, $30,000 a year. Your expenses, $12,000 a year. That produces an NOI, a net operating income, of $17,800 per year. That's just your income minus your expenses. The total cost of the property, which would be the purchase price plus the cost to fix it up, and you'd have your closing costs in there as well. That's what you have into it. So this number here is your yield on cost. It's just your net operating income divided by the total cost. So you can see without leverage, how is this deal performing? Because it's worth now more than I have into it, I gained something called sweat equity or forced appreciation. In this case, I didn't force it. It's just organic appreciation from the market doing decently. So that amounts to about $38,000 and, just money to my net worth that I gained in the few years that I've owned this property. Cash in deal. So here we get to different ways where you could structure a deal. If you purchased it just with cash, here's how much cash flow you get. Because you don't have any debt service, your cash flow is just your net operating income. and you'd be getting a return of about 13%, which is pretty good. Like, that's almost double what you might expect to get from the stock market or something. And typically real estate deals, you don't see numbers like that strong, but in my market in the Midwest, you do tend to get deals that cash flow better than in other markets, and that is what I can attribute that to mostly. That, and it's just a good deal. So this was if you were to buy it with a conventional mortgage. So like you're putting 25% down to purchase it. In a 30-year fixed loan, you can put your debt terms in here. So I personally put 25% down. That's what's required for multifamily properties, or at least it was of me. The interest rate, 4%. Duration, it's 30-year fixed. So that means cash I have in this deal, it's $36,540. Leverage, that's the loan amount, it's about $10,500. So that leaves me after debt service. The debt service gobbles up almost $6,000 of my net operating income each year. So that leaves me with about $12,000 left. In practice, these assumptions seem to be greater than reality in terms of the expenses, because last year this property, on my taxes at least, when I summed up all the income and expenses, it ended up being about $17,000. So sometimes you might get lucky. I have other properties that, when I did my taxes, didn't show any income last year because I had turnover, I made improvements. So sometimes that happens too. But across the portfolio, if you stick to these assumptions, it'll average out being fairly accurate over time. Cash on cash return. So this is the yield on dollars that you have in the deal. So cash flow divided by cash in deal is how you get this number. That's most 33%. That's pretty darn good. If you include principal pay down, which first year is about $1,800, that jumps to about 38%. Also fantastic. Another thing you could do if you don't want to have money in the deal is cash out refinance after the deal is done. Because I have equity in this deal, I could do that now. And these are the types of numbers that I could get. I'd lose a bit of cash flow. One thing that's wrong here is if I did do a refi, we no longer have 4% interest rates. I'd be paying like 7.5%, and that would cut my cash flow in half. So I don't know. When you factor in lending costs and the rising interest rates, it's not worth it to me to refinance this property. I'll just keep it as is because I already have all of my money out of it just from the cash flow over the time I've owned it. So we can look at return over time here. You can see the income, expenses, the net operating income, how they change over time. Ideally, you get properties that look pretty good year one, but if that's all you're looking at, a lot of deals might look kind of flimsy. Sometimes it's better to look at it 5 years out, 10 years out. What's it actually going to be doing then? Particularly if you're interested in real estate as like a vehicle to enable your retirement or something in the future. You don't just care about today, you care about the future. So this gives you kind of a snapshot of that. Although I do strongly recommend buying stuff that cash flows or has the capability of doing it right out of the gate, because cash flow, it's a defensive tool. If you have a property that's making money after debt service, the chances of you losing that property go down drastically, because personal hardship isn't going to limit your ability to pay. The property can stand on its own. So here you have your principal pay down for different things. I guess I should get into the SPUR acronym. It's just buy, rehab, rent, refinance, repeat. So that's not so applicable to this particular deal because it was a cash flow play. But if you do get such a deal, that's where these numbers might be more intriguing. Cash, you leave the most money in the deal, you have the most money in the deal, so your returns are less. If you buy it with like a 20-25% down payment, the money in the deal goes down, so your returns are greater. If you do a BRRRR deal, the cash out refi after all the work is done and it's cash flowing solidly, then you are generally left with very little money in the deal or none. So the returns are drastically higher because the number you're dividing by goes down, and eventually you're like dividing by 0, so you get infinite returns. Speaking of which, let's go to the next deal here. This is a single family house that I got in Warren, Michigan in 2020. I purchased it for $50,000. I spent $36,000 fixing it up. Then it appraised for $120,000. So that leaves us with a sweat equity of $31,500. And that's just one single family house where I paid somebody to do all the work on it. So that's not bad. That's half of like the median salary that, somebody might be getting at their 9 to 5. So having that in one deal where you didn't have to do a lot of like heavy lifting, that's pretty solid. It's not to be understated. This one, let's see, it rents for $1,350 a month. Maintenance, I've had to replace a furnace once on this property. That's about it. The tenants there are fantastic. They take amazing care of the place. So expenses are actually quite low. Again, I manage it myself, so there's nothing in there. Utilities, it's a single family house, so the tenant's paying all of the utilities. Insurance about $650, taxes about $1,300. I think it's gone up a little bit. These are essentially the sheets that I filled out when I was doing the deals initially. Sometimes I might update them a little bit just to see how the numbers look today, but to some extent these are older numbers representative of what it looked like when I initially made the purchase. So we got into the outputs here, total cost that I had into it. This one I didn't finance the purchase. It was $88,500 cash. Sweat equity, we went over that. Yield on cost, 12.44%. Again, that's pretty good. It's a nice number to see when you're looking at a real estate deal. And the way I played this deal, I purchased it with cash, I rehabbed it with cash. Then when I did the cash out refinance, it was worth $120,000. It's single family, so I could do a cash out refi. It's 75% loan to value. And that meant that I had negative $1,500 in the deal. I own this property, it's cash flowing, and I essentially got paid $1,500 to own it, which is great because that brings us to infinite returns, where you don't have money in the deal, but you have cash flow, so you're dividing by 0 essentially, so you can't do that. It's just infinite. So you're getting something from something that you don't have any of your initial money into. That's what I like to aim for on every deal if I can. Not all of them will hit it, but it's a really good target. And, speaking of not being able to hit that number, here's another deal that I did where it's a market that I like a lot. I think there's a lot of good stuff going on in this area, and you can do deals that pencil out pretty nicely. You get a fantastic return on it, but because it is a pretty cool, desirable neighborhood in Detroit, the cash in deal, like generally speaking, you're going to leave a little bit more money in that deal. Fortunately, in my case, because I did the significant value adds, and my properties rent out for quite a bit in this neighborhood. I have 10 units there now. The payback period's very small. I'm not going to go through everything specific here because we've done that in the previous few, but you can see my purchase, the rehab, the ARV. That's what it appraised for at the time. Right now, I'd say it's worth more like $350. I think that appraisal is done in 21, maybe 22. But yeah, that's the idea of my income and expenses. This one, it's a slightly lower yield on cost because it's kind of a nicer area. More people want to invest there. There's more competition. So there's that going on. But also because I did a major rehab, I gained quite a bit of sweat equity. If you look at it, the total amount that I had invested was about $260,000. Then it appraised for $330,000. So that is, about $70,000 of money that I added to my net worth. And when I worked as an engineer, my salary was more than that, but not super drastically so. That's a pretty nice gain to achieve just from this one deal where, again, I hired out the majority, if not all of the work. I did it as a BRRRR deal where I bought it, I rehabbed it, I rented it out, I refinanced it, and repeated onto next ones. So that means my cash in deal now, it's about $28,000. But not really, because I've owned it for a couple of years now doing these numbers. The cash flowing $14,000 per year or more. again, this is one where I did a full rehab, so my expenses are low. It's already paid for itself, so it's into the infinite return territory just because we're a little bit further along on this return over time, you know, whatever. Something I didn't mention before, it's the amortization tables. So that's something that goes into the calculations here, but it's good to see over time, as a loan matures, a greater share of the payment you're making goes towards paying down principal and less of it goes to paying down interest. When you first take out a loan, your payment in this case, okay, so like 476, about a third of that's going to the principal and 2/3 is interest. So interest is the majority of it by far. But you get a little, well, this is conventional. This is more representative of my real numbers. I was going to say that sounded really small. But the payment, it's $1,100. Again, the vast majority, about 2/3, is going to interest. And as you get towards the end of the loan, it goes down significantly, and the majority of it's principal. So, you can look at these. They're kind of fun to see. But that's that deal. And pretty representative of, I guess in this particular neighborhood, it's getting harder to find deals like this. I was fortunate to start out before there was like a ton of hype there. But now it's getting more hyped and there's a lot of good stuff happening. So these deals there, at least in that particular location, might become more scarce. Or they already are. I'm seeing it. And, another thing is when I started investing in this neighborhood, there were no good sales comps. None. So it was a little bit like you buy the thing, you fix it up really nicely, and hope that the appraiser treats you nicely. Fortunately, on some of these deals, I had pretty good luck. Sometimes the appraisals were a little bit softer. But in any case, I'm leaving a bit more money in the deal, but because they cash flow so strongly, I still get a very good return on that money left in the deal. And I got enough out where I can continue to reinvest and do more deals in the future. So this is the 10-unit building that I did my previous video on, and I'll have a video like in the end card thing for this video where I actually go over this sheet specifically. I'm not going to focus on it much here because I already went more in depth on it, but just to give you an idea, I was about $600,000 into it. I forced about $500,000 of equity, which is friggin' sweet. Yield on cost is off the charts insane, and it's an infinite return deal where I pulled out $150,000, more than I had into it. If every deal I did were like this, shoot, I'd never stop. Like, that's amazing. This is kind of like a home run deal. Not every deal you do will put down these kinds of numbers, but if you're, stick with it and keep doing deals, you'll get one every so often. So if this is like a home run deal, maybe most of the deals you do are just kind of base hits. So don't count on getting this, but just when it does happen, be duly excited because it really is sweet. But anyway, that's kind of the gist of this video. You now know how my rental property spreadsheet works, and you, more importantly, have access to it so that you can use it for your own deals. So again, go to kurtbagney.com. You can download this. You can also subscribe to a mailing list on there. I'm probably not going to send stuff out hardly ever, but I've been using this sheet for a while now, and I'm already starting to notice some deficiencies with it, things where I'd like to add additional features. So this will come down the road. I still have to put out a video with it as is because it's useful, and it served me well for everything that I've done up to this point. But now that I'm looking at bigger multifamily deals, I find that it's lacking in features. And if you subscribe as I make changes to this one or add new features, you'll be abreast of that, and maybe I'll notify you of new content and so on too, but we'll see how that ultimately plays out. But anyway, thank you for watching. If you got value out of this, do the YouTube stuff like subscribe, comment, and hope to see you watching the next one. So have a good one. Bye.